3 days. Just 3 days to witness what financial historians will study for decades. What I'm about to show you isn't just another market story. This is about how $10 trillion disappeared while you were having your morning coffee, and why almost nobody is talking about the real reason behind it. Before we go any further, I need you to do something. Hit that subscribe button right now, because what you're about to learn, they don't want reaching millions of people. And if this video helps you understand what really happened, smash that like button so the algorithm pushes this to everyone who needs to see it. Trust me, you'll want to share this with at least one person by the end. Let's talk about something that should terrify you. Between Tuesday and Friday of last week, the precious metals market didn't just drop. It was systematically dismantled. Gold fell 15%. Silver, 40%. And here's the part that should make you pause. It all happened in 6 hours. Not 6 days, not 6 weeks. 6 hours. Think about that for a second. No major war broke out that morning. No pandemic was declared. No financial institution collapsed. The news channels were completely silent. Yet somehow, $10 trillion in wealth just evaporated. Gone. As if it never existed. But here's what makes this truly chilling. While your portfolio was bleeding, while traders across the globe were getting liquidation notices, while $10 trillion was being erased from existence, something else was happening in Washington that nobody connected. The United States government was hours away from a complete shutdown. Chaos layered on top of chaos. And right in the middle of all that uncertainty, we witnessed the largest single-day destruction of precious metals wealth in recorded history. You think that timing was random? Stay with me, because by the time we're done, you're going to see a pattern so clear, so deliberate, that you'll never look at financial markets the same way again. I'm going to be completely honest with you. You're probably watching this because you're hurting right now. Maybe you held gold. Maybe you had silver positions. Maybe you watched years of careful gains disappear in a single afternoon, and nobody gave you a real explanation. They called it a market correction. They said prices got ahead of themselves. They used words like healthy and natural. Let me tell you something. This wasn't healthy. This wasn't some invisible hand of supply and demand finding balance. What happened over those 72 hours was choreographed, rehearsed, and executed with military precision. And today, I'm walking you through it, step by step, player by player, move by move. This is Money Aftermath, where we dig into what really happens when the markets move and why. If you're new here, welcome to a channel that doesn't just repeat what you hear on mainstream financial news. We go deeper. We ask questions nobody else is asking. And we follow the money trail wherever it leads. Now, let me take you back to where this really started. Tuesday, January 27th. Most people were going about their day. The news was background noise. President Trump was speaking, and buried in his remarks was a single sentence that most of America completely missed. He said that a weaker dollar would help American businesses compete globally. He suggested the United States should follow what China and Japan have been doing for years. Devalue the currency to boost exports and make American products cheaper on the world stage. To someone watching casually, this sounds like boring policy talk. Economic jargon, nothing urgent. But in trading rooms from New York to London to Hong Kong to Singapore, phones started lighting up immediately because professional traders understood exactly what had just been signaled. The President of the United States had just announced he wanted a weaker dollar. And when the dollar weakens, something very specific happens to precious metals. They rise. Because gold and silver are priced in dollars globally, a weaker dollar means it takes more dollars to buy the same ounce of metal. Within hours, the trade was on. Hedge funds started shorting the dollar. Asset managers started loading positions in gold. Retail traders piled into silver. Billions of dollars moving in a single direction, all betting on the same outcome. Weak dollar equals strong metals. That was Tuesday. The trap had just been set, and nobody realized they were walking straight into it. Fast forward to Thursday, January 29th. Gold hits $5,600 per ounce, the highest price in human history. Silver breaks through $121. These weren't just new records. These were numbers beyond what most analysts thought possible. Silver had gained 68% in January alone. Let that sink in. 68% in a single month. That's the strongest monthly performance since December 1979, nearly 50 years ago. Social media was exploding. Every financial influencer was bullish. Analysts were projecting $200 silver. Some said 300 was inevitable. A few even whispered about 500. Earlier that week, the iShares Silver Trust saw $171 million flow in from retail investors in a single day. $171 million. That was the largest single-day inflow in the history of that fund. It doubled the previous record set during the famous silver squeeze of 2021. The total silver market had ballooned to $6 trillion. To put that in perspective, that's larger than Nvidia, larger than Apple, larger than Alphabet. One market analyst looked at the frenzy and called silver the meme commodity of 2026. Everyone was euphoric. Everyone felt like a genius. Portfolios were up 50%, 100%, some even 200%. Thursday night, people went to sleep planning early retirements, dreaming about financial freedom. And none of them knew that while they slept, the execution order had already been written. Friday, January 30th, 6 in the morning Eastern Time. Most of America is still asleep. Markets haven't opened. Coffee makers are just starting to brew. And then a headline drops. President Trump announces his pick for the next Federal Reserve Chairman, Kevin Warsh. Now, if you're not deep in financial circles, that name probably means nothing to you. Just another suit, another Washington bureaucrat, another face in the endless parade of economic officials. But if you understand how the Federal Reserve controls the entire financial system, that name just sent a chill down your spine. Kevin Warsh isn't just any economist. He's what people in the industry call a hard money hawk. This is a man who has spent his entire career advocating against easy monetary policy, against low interest rates, against currency devaluation. He believes in a strong dollar, the exact opposite of what Trump signaled on Tuesday. Do you see what just happened? Let me spell it out clearly. On Tuesday, Trump signals he wants a weak dollar. Traders respond by shorting the dollar and buying precious metals. On Friday, 72 hours later, Trump appoints a Fed chairman who is known for supporting a strong dollar. The same traders who shorted the dollar on Tuesday were now forced to reverse their positions on Friday. The same traders who loaded up on metals on Tuesday were now forced to sell on Friday. Forced reversal. Forced liquidation. All within 72 hours. Same president, opposite signals, 3 days apart. That's not confusion. That's not a policy mistake. That's a trap that snapped shut in 72 hours. But even with the Warsh announcement, silver should have fallen maybe 15, maybe 20% at most. A painful correction, yes, but survivable. Markets would digest the news, find a new level, and move on. What actually happened was 40% destruction in a single session. How was that even possible? Because there was a third player in this game. A player most people never saw coming. China. Let me explain how precious metals markets normally work. When prices start falling rapidly, there's usually a buyer waiting somewhere. Someone who sees value at lower prices. Someone who steps in and says, at this price, I'm buying. For precious metals, that buyer has historically been China. They're the largest consumer of silver in the world. They use it for solar panels, for electronics, for electric vehicles. They have massive industrial demand for the metal. Usually, when silver crashes, China steps in. They buy the dip. They provide liquidity. They put a floor under the price. But Friday was different. At the exact moment when the market desperately needed a buyer, at the exact moment when sellers were overwhelming the system, at the exact moment when liquidity was vanishing, China made a very specific decision. They stopped buying. The Shanghai Exchange suddenly raised margin requirements. They stepped back and watched the carnage unfold. Think about what that created. American traders scrambling to sell their gold and silver because Kevin Warsh signals tighter monetary policy ahead. But the buyer, who always catches falling metals, just walked away from the table. Sellers everywhere, buyers nowhere. What happens in a market when everyone wants to sell and nobody wants to buy? The price doesn't decline gradually, it collapses catastrophically. And that's exactly what we witnessed. The algorithms smelled blood. Stop losses started triggering across the board. Margin calls went out from every major brokerage in America. Traders who were up 100% the week before were suddenly getting forced liquidation notices. And once that cascade started, nothing could stop it. Silver went from 121 to 115, then to 110. Then it broke below 100 for the first time in weeks. That psychological level that everyone swore would hold forever, gone in minutes. 95, 90, 85, 80, 75, $46 erased in 6 hours. The ProShares Ultra Silver ETF, ticker AGQ, crashed 60% in one day. If you had $10,000 in that fund Thursday night, you woke up with $4,000 Friday afternoon. Gold fell from $5,600 to $4,700. $900 per ounce vanished. $3.4 trillion of gold market value wiped out in a single session. The biggest single-day drop since 1980, 45 years ago. One trading desk described it as a capitulation event. Another called it the largest single-day wealth destruction in precious metals history. One session. Gone. Now here's where this gets really interesting, and I need you to pay close attention because this part changes everything. After the crash, I went through the actual trading data. Not the headlines, not the expert analysis, the raw data from the exchanges themselves. And what I found is absolutely stunning. On Friday, 531 tons of silver contracts were traded in Shanghai. 531 tons. That sounds massive, right? That sounds like real selling. That sounds like actual panic, people dumping their physical silver onto the market. But here's what the data actually shows. Physical silver withdrawn from Shanghai vaults on Friday? 0. Let me repeat that. 531 tons of silver contracts traded. 0 tons of physical silver moved. Not a single ounce of actual metal left the vaults. So what really happened? Paper contracts? Pure paper trading. Short sellers needed an exit from their positions. They got it by pressuring the price down with contracts that weren't backed by physical metal. They closed their shorts at lower prices, and buyers absorbed everything at the bottom, all on paper, while the actual physical silver sat completely untouched in vaults. This wasn't a crash, this was a position transfer, shorts exiting, new longs entering, paper changing hands. The screens showed absolute chaos. Now let me show you a number that should make your jaw drop. When the COMEX market closed on Friday, the paper price of silver was $84. On the same Friday, when physical silver was actually being sold in Shanghai, the price was $122. Same metal, same day, 44% difference. Let me make absolutely sure you understand what I'm saying. If you tried to buy silver on a screen in New York, the price showed $84. If you tried to buy actual physical silver in Shanghai, you had to pay $122. In Tokyo, physical silver was selling for $150, a 44% gap between paper price and physical price, on the same day for the same metal. So which price is real? The paper price that can be manipulated with contracts backed by nothing, or the physical price where actual metal changes hands between real buyers and sellers? Here's what they don't want you thinking about. In the weeks before this crash, physical silver was selling for $120 to $150 at dealers around the world, and it was sold out. Dealers had no inventory. Demand was crushing supply. If you're a dealer and customers are lining up to pay $150 for physical silver, and your inventory is completely sold out because demand is so overwhelming, why would you suddenly lower your price just because a screen in New York shows 84? You wouldn't. The screen shows one number, reality shows another, and the gap between them is 44% and growing. But here's what really convinced me this entire event was choreographed. Remember when the crash happened? Friday, January 30th, the last trading day of January, month end. Now let me take you back exactly 1 month. December 31st, the last trading day of December, month end. What happened that day? Silver dropped 15% in a single day, same pattern, same timing, month end. And what happened after December 31st? Silver continued rallying through January, hitting all-time highs. Now January 30th arrives, last trading day of January, month end. Silver drops 40%, 2 consecutive month-end periods, 2 massive drops, same exact pattern. Are you starting to see it? Let me show you what else happened on those specific days. On December 31st, the Federal Reserve's standing repo facility handed out a record amount of dollars to banks, record-breaking, the highest level ever recorded. And what was happening in Washington on January 30th while silver was crashing? The government was teetering on the edge of shutdown. Congress was scrambling. Complete chaos. Here's the connection nobody is discussing. The banks that received those record repo dollars on December 31st, they're the same institutions that hold massive short positions in silver. The data is publicly available. You can verify this on Fred. You can check it on CME reports. Anyone can look this up. Month end is when banks need to clean up their balance sheets. Month end is when they need to close out positions. Month end is when they need maximum liquidity. And month end, twice in a row now, is exactly when silver mysteriously experiences catastrophic crashes. December 31st, repo reaches record levels. Silver crashes 15%, then recovers. January 30th. Government chaos, same pattern, same timing, same players involved. This isn't coincidence, this is a schedule, a script that runs on a calendar. Now let me show you what the CME, the Chicago Mercantile Exchange, was doing behind the scenes while all of this was unfolding. December 12th, 6 weeks before the crash. Silver is rallying hard, making headlines. Regular people are making real money, and quietly, without any major announcement, the CME raises margin requirements by 10%. Nobody really notices. That was the entire point. December 29th, silver keeps climbing. The CME raises margins again. 25% increase, overnight, no warning. December 30th, less than 24 hours later, they raise margins again. 2 increases in 2 consecutive days. January 28th, 3 days before the crash. The CME changes the entire margin calculation system. Fixed dollar amounts become percentages. 9% becomes 11%, 4 margin hikes over 6 weeks. An 80% increase in the cash required to hold a position. Now let me explain what that means for someone trading on margin. You bought silver at $60. You've been riding this incredible rally for months. Your account is way up. You're feeling good about your positions. Life is good. Then suddenly, without warning, your broker sends you a notification. Your margin requirements have increased. You need 80% more cash in your account immediately, today, right now, or your positions get liquidated. Where does that cash come from? So they get liquidated, forced to sell whether they want to or not. And when thousands of leveraged traders are forced to sell at exactly the same time, the price doesn't just decline, it collapses. But here's what should really disturb you. After Friday, after the crash, after $10 trillion vanished, the CME raised margins again Saturday. The day after the massacre, another increase. Gold margins going from 6% to 8%. They raised margins before the crash to cause forced selling. Then they raised margins after the crash to prevent recovery. If this was truly about risk management, they would lower margins after volatility subsides. Let the market heal. Let traders recover. Instead, they increased the pressure. They kept their boot on the neck. That's not protection, that's suppression. Now, and this is crucial, let me show you why this matters beyond just Friday. This isn't the first time they've run this exact playbook. 1980, silver runs from $6 to $50, an 800% gain, regular people making fortunes, the Hunt brothers attempting to corner the market. What happened? The CME created something called Silver Rule 7. It banned leveraged buying overnight. The Federal Reserve raised interest rates from 11% to 20% in a single move. Result? Silver crashed from $50 to $10, an 80% destruction of value. 2011, silver runs from $8 to $50, 600% gain, retail traders everywhere making money, major banks with massive short positions getting crushed. What happened? The CME raised margin requirements 5 times in 9 days, 84% increase in required capital. Result? Silver crashed from $50 to $26, 50% destruction. It took 13 years to recover to those levels. Now, 2026, silver runs from $26 to $121, nearly 400% gain. The biggest rally in modern history. What happened? The CME raises margins 4 times in 6 weeks. China raises margins and steps away from buying. Fed chairman announcement, time for maximum reversal impact. Government on the edge of a shutdown, creating additional chaos. Short sellers get their exit through paper manipulation, while physical metal sits completely untouched in vaults, coordinated across continents with precision that would impress military strategists. Result? Silver crashes 40% in a single day, the fastest destruction of the 3 historical events. 1980, 2011, 2026. Same pattern, same tools, same timing, same outcome. 3 times in 50 years. Every single time, silver threatens to break free from their control. Every single time, regular people start building real wealth in precious metals. Every single time gold and silver start exposing the fundamental weakness of paper currency. The exact same script gets executed. Once is an accident, twice is coincidence. But here's what should make you absolutely furious. While paper prices were crashing, while retail traders were getting liquidated, while $10 trillion was being erased from screens around the world, guess what central banks were doing? Buying, not selling. Buying. 800 tons of gold accumulated by central banks last year, the fastest accumulation pace in decades. The dollar's share of global currency reserves has dropped to 58%, the lowest level since 1995. For the first time in modern financial history, gold now represents a larger share of central bank reserves than United States Treasury bonds. Let that statement sink in for a moment. Central banks around the world now trust a metal that can't be printed more than they trust America's promise to repay its debts. They crash the paper price. Then they buy physical at the discount they just created. Retail investors panic and sell. Central banks accumulate in silence. It's the greatest wealth transfer in modern history, and it happens every single time they execute this script. Now I want to talk directly to you for a moment. I know you might be scared right now. I know some of you watched your portfolios bleed. I know you're wondering if you should sell what's left and just walk away from precious metals entirely. Let me share something with you. When silver was at 121 and everyone was euphoric, when every influencer was screaming about $500 silver, the principle that's worked for centuries still applied. When everyone is greedy, be cautious. And now, when the market is drowning in fear and panic, when people are selling in desperation, when blood is literally in the streets, basic market logic says the opposite. When everyone is fearful, that's historically been the time for careful consideration. I'm not giving you financial advice. I'm not telling you to buy or sell anything. That's your decision based on your situation. I'm just sharing how markets have functioned throughout history. Fear and greed, cycles that repeat endlessly. The people who panic sell at the absolute bottom usually regret it later. The people who buy when there's blood in the streets often remember it as their best decision. Which category will you fall into? That's entirely up to you. Here's the question I cannot stop asking myself, and I want you to think about this too. If gold and silver truly don't matter anymore, if they're just relics of an outdated economic system, if they have no real place in modern finance, then why do they keep doing this? Why coordinate a Fed chairman announcement with a market crash? Why have China stepped back at the exact moment liquidity was desperately needed? Why raise margins 4 times before the crash and once after? Why does the paper price show 84 while physical metal sells for 150? Why run the exact same script on the last trading day of December and the last trading day of January? Why does the standing repo facility hand out record dollars to the same banks that hold short positions in silver? Why spend so much coordinated effort suppressing something that supposedly doesn't matter? They tell us it's just market forces. They say it's supply and demand finding equilibrium. They call it normal volatility. But $10 trillion don't vanish in 6 hours by accident. 531 tons of paper contracts don't trade, while 0 physical metal moves by coincidence. 44% gaps between paper price and physical price don't appear in healthy, functioning markets. You don't fight this hard against something that has no value. The intensity of the attack reveals the importance of the target. They're not protecting the market. They're protecting the dollar, protecting the system, protecting the narrative that paper money works just fine. And the fact that they keep running this script, the fact that they've executed it 3 times in 50 years, the fact that they will absolutely do it again in the future, tells you exactly what precious metals represent to them. A threat, a way out for regular people. Real money that exists outside their control system. That's why they attack it. That's why they crush it when it rises too high. That's why they will never stop trying to suppress it. Because if gold hits 10,000 and silver hits 300, what does that say about the dollar? What does that say about 50 years of endless money printing? What does that say about the entire financial system they've constructed? It says the paper has failed. It says the game is ending. It says everything they've told you for decades was a carefully constructed lie. That message cannot be allowed to spread to the masses. So they write scripts like this one, Tuesday, Thursday, Friday, 72 hours of controlled demolition. And they expect you to panic. They expect you to sell at the bottom. They expect you to give up and walk away from precious metals forever. But now you know the script. You've seen the 72-hour timeline laid out. You've seen Trump's contradicting signals just 3 days apart. You've seen China's perfectly timed exit from buying. You've seen the 531 tons of paper with 0 physical movement. You've seen the 44% gap between screen price and actual price. You've seen the month-end pattern repeated twice. You've seen the standing repo connection to short-selling banks. You've seen the margin hikes before and after the crash. You've seen the same exact playbook executed across 50 years of financial history. It was scripted, every single piece of it. They called it a market crash. I call it the 3rd time in 50 years they showed you exactly what they fear most. They called it healthy volatility. I call it a 72-hour execution. They called it risk management. I call it the system revealing its hand. And what they fear is devastatingly simple. You holding real metal outside their system, beyond their control. Remember that 44% gap I showed you? Paper at 84, physical at 150? That gap isn't a technical glitch. That's the system telling you which price represents reality. Paper is just a promise. A number on a screen that can change instantly. Metal is tangible. It sits in vaults. It can't be printed by central banks. It can't be hacked by cyber criminals. It can't be margin called out of your personal safe. They can crash the paper price whenever they need to. They cannot crash the metal itself. They can liquidate your futures contracts with the click of a button. They cannot liquidate the silver bar sitting in your physical possession. 3 times in 50 years they've run this script, and 3 times silver eventually recovered and went higher than before the crash. The question isn't whether silver will recover. History strongly suggests it will. The real question is whether you'll still be holding your position when it does. I started this video talking about 72 hours, Tuesday, Thursday, Friday. Now you've seen the complete picture. The setup, the peak, the execution. It was scripted from the beginning, written in advance, rehearsed over 6 weeks of margin increases, timed perfectly with government chaos, executed with paper contracts while physical metal sat completely untouched, coordinated across multiple continents with precision that would make military planners jealous. They called it a market event. I call it financial warfare. And I call it the clearest signal in 50 years of what they truly fear. Real money in real hands, far beyond their reach and control. Now you know the script. What you choose to do with this information is entirely your decision. But remember this moment. Remember how you felt watching your portfolio bleed. Remember the fear. Remember the confusion. Remember how they gave you absolutely no explanation while $10 trillion vanished into thin air. And remember that you now understand something most people will never grasp. It was scripted from beginning to end. If this video helped you see what really happened behind the scenes, I need you to do something for me. Share this with one person who needs to see it. One person who panicked on Friday. One person who's thinking about selling at the absolute bottom. One person who deserves to know the truth before they make a decision they'll regret for years. That's how we fight back against the system. Information, understanding, Truth spreading from person to person. Drop a comment below right now. Tell me, after everything you've seen today, after understanding the full 72-hour timeline, are you holding your positions or are you selling? I read every single comment. Your perspective matters. If you haven't already, subscribe to Money Aftermath right now. This is where we expose what they don't want you seeing. This is where we follow the money trail regardless of where it leads. This is where we ask the questions nobody else is willing to ask. The script has been exposed. The pattern is clear. The question is, what will you do with this knowledge? This is Money Aftermath. The truth about what really happened is now in your hands.